January 2026. Silver just crossed $94 per ounce. The financial media is calling it a rally. The institutions are calling it a correction. But behind the polished headlines and the reassuring analyst notes, something far more dangerous is unfolding. This isn't just a price spike. This is a short squeeze going vertical. And if you don't understand what's happening right now, you're about to become collateral damage in one of the most violent market dislocations in modern history. While retail investors celebrate the gains, the smart money is quietly positioning for a massacre. They've done this before. They'll do it again. And this time, the warning signs are flashing red across every single technical indicator, every sentiment gauge, every corner of the derivatives market. The question isn't whether a crash is coming. The question is whether you'll see it before it's too late. Let me take you back to where this story really begins. For over 2 years, silver traded in a tight range between $22 and $28. Boring, predictable, dead money. The kind of asset that financial advisors told you to avoid because there's no growth story. Institutional portfolios rotated out. Hedge funds moved to Bitcoin, to AI stocks, to anything with momentum. Silver became the forgotten metal, the overlooked commodity in a world obsessed with technology and digital assets. But underneath that quiet surface, something was building, something the mainstream refused to acknowledge. The physical market was tightening. Industrial demand was surging. Electric vehicles need silver. Solar panels need silver. The green energy transition that governments are forcing onto the global economy, it runs on silver. And here's the problem. There isn't enough of it. Then came November 2025. Silver broke above $30. Suddenly, the financial media noticed. Silver breaks out, they said. Commodities rally continues. But they missed the real story, because while the price was climbing, the short interest on the COMEX was reaching historic levels. Institutional traders, the big banks, they weren't buying the rally, they were shorting it. Massively, recklessly. They were betting billions that this breakout was false, that retail investors would panic, that the price would collapse back into the range. They were wrong. By December, silver hit $50. The shorts doubled down. By early January 2026, it touched $70. The shorts didn't cover, they added more. And now today, at $94 per ounce, we're watching something that hasn't happened in the silver market since the Hunt brothers tried to corner it in 1980. We're watching a short squeeze go parabolic. We're watching forced liquidations. We're watching institutional traders trapped in positions they can't exit without triggering a cascade that could take down entire trading desks. The response from the financial establishment has been swift and coordinated. The CME Group, the exchange that operates the COMEX futures market, raised margin requirements 3 times in 2 weeks. They're calling it prudent risk management. But let's be honest about what this is. It's an attempt to kill the rally. When you force traders to put up more capital to hold their positions, you're forcing liquidations. You're trying to break the momentum before it breaks you. Central banks aren't silent either. The Bank for International Settlements released a carefully worded statement about monitoring commodity volatility. Translation, they're terrified. Because silver isn't just a commodity, it's money. It's been money for 5,000 years. And when the price of silver explodes like this, it's sending a message about the value of everything else. It's sending a message about fiat currencies, about the dollar, about trust in the system itself. In Asia, the reaction has been different. China's State Administration of Foreign Exchange quietly increased its strategic metals reserves in December. They didn't announce it. They didn't issue a press release. But the import data doesn't lie. While Western banks were shorting silver, China was buying physical metal. So was India. So were the central banks of nations that understand what's coming. Meanwhile, on Wall Street, the narrative control is in full effect. CNBC brings on analysts who explain that silver is overbought, that the fundamentals don't support these prices, that it's a speculative bubble driven by Reddit traders and conspiracy theorists. They're not wrong about the speculation, but they're lying about the fundamentals, because the fundamentals for silver have never been stronger. And the people telling you to sell, they're the same people who need you to sell so they can cover their shorts before the real squeeze begins. Let's talk numbers, real numbers, not the sanitized data they feed you on Bloomberg terminals. According to the latest CFTC Commitment of Traders report, commercial traders, the big banks and institutional players, are short over 400 million ounces of silver in the futures market. 400 million ounces. To put that in perspective, global annual silver mine production is roughly 850 million ounces. These institutions have shorted nearly half of global annual production. In a market where physical inventories are at multi-decade lows, the COMEX warehouses, the registered inventories available for delivery, currently hold around 70 million ounces. That means the short interest is more than 5 times the available physical metal. If even 20% of those contracts demand physical delivery, the exchange cannot fulfill them. It's mathematically impossible. And that's when the real chaos begins. That's when you get force majeure declarations, cash settlements, legal disputes, and a complete loss of faith in the paper derivatives market. Now, let's look at the technical picture. The 60-day realized volatility on silver has spiked to levels not seen since March 2020 during the COVID market crash. The implied volatility on options is pricing in massive moves. The skew is broken. Put options are trading at premiums that suggest institutional players are desperately trying to hedge or exit. And the open interest on out-of-the-money call options? It's exploding. That's not retail speculation. That's gamma exposure. That's market makers being forced to buy more silver to hedge their options books, which pushes the price higher, which triggers more calls, which forces more buying. It's a feedback loop, a reflexive cycle that feeds on itself until something breaks. The chart tells a story too. Silver broke through every major resistance level without even pausing. The 50-day moving average crossed above the 200-day in November. That's a golden cross, a signal that technical traders live and die by. Then it broke the 2011 high of $48. Then it took out the psychologically critical $50 level. And now, at 94, it's approaching the inflation-adjusted high from 1980, which sits around $140. If that level breaks, there is no chart resistance left. There is no historical precedent. The price discovery happens in real time, in a market gripped by panic and FOMO and forced liquidations. We've seen this movie before. In 1979 and 1980, the Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, attempted to corner the silver market. They accumulated massive physical positions. The price went from $6 to $50 in a matter of months. The establishment panicked. The comics changed the rules mid-game. They banned new long positions. They forced liquidation-only trading. The price collapsed. The Hunts were destroyed. And the message was sent, you don't bet against the system. But here's what they don't tell you. The Hunt brothers weren't wrong about silver. They were early, and they were over-leveraged. The fundamentals they saw, the monetary debasement, the supply constraints, those were real. What killed them wasn't bad analysis. It was the fact that the exchange and the regulatory apparatus changed the rules to protect the institutions that were on the wrong side of the trade. Fast forward to 2011, silver hit $49 in April of that year. It was driven by fears of monetary collapse, by quantitative easing, by retail investors piling into precious metals as a hedge against inflation. And then, within weeks, it crashed back to $26. A 46% collapse in a matter of days. What happened? The CME raised margin requirements 5 times in 9 days. They broke the rally, they forced liquidations, and once again the retail investor was left holding the bag while the institutions walked away. But 2026 is different. The physical market is tighter than it's ever been. The short interest is larger. The global monetary system is more fragile. And the retail investors, they've learned. They're not trading on margin. They're buying physical. They're holding. They're calling for delivery. And that changes everything. So what's really driving this? Why is silver, a metal that's been suppressed and ignored for decades, suddenly the most dangerous asset on the planet? The answer is simple. The everything bubble is collapsing, and silver is the canary in the coal mine. For over a decade, central banks have pumped trillions of dollars into the financial system. Quantitative easing, zero interest rates, negative rates. They've inflated asset prices to levels that defy logic. Stocks, bonds, real estate, all of it propped up by cheap money and the implicit promise that the Fed will never let anything fail. But that money didn't just inflate financial assets, it degraded the currency. And people are starting to notice silver is real, it's tangible, it's finite. You can't print more of it, you can't create it with a keystroke. And in a world where trust in fiat currency is eroding, where inflation is running hotter than official statistics admit, where geopolitical tensions are fracturing the global order, silver becomes a store of value, a safe haven, a bet against the system. But there's another layer, industrial demand. The global push for green energy, electric vehicles, 5G infrastructure, all of it requires massive amounts of silver. Solar panels are the biggest growth driver. Each panel uses about 20 grams of silver. The International Energy Agency projects that solar installations will triple by 2030. That's hundreds of millions of additional ounces of demand, and the mining industry can't keep up. Primary silver mines are rare. Most silver comes as a byproduct of copper, lead, and zinc mining. And those operations are facing rising costs, environmental regulations, and geological depletion. On the supply side, we're facing a structural deficit. More silver is being consumed than mined. Inventories are being drawn down. And unlike gold, which gets hoarded and recycled, silver gets used. It gets consumed in industrial applications and never comes back. The above-ground stockpiles that existed in the 1990s, gone. The strategic reserves governments used to hold, sold off decades ago. This is a market that's been set up for a squeeze. And the institutions that shorted it, they either didn't see it coming or they thought they could control it. They thought they could manipulate the price, suppress the rally, and walk away with profits. But the physical market doesn't care about paper contracts. And when the two diverge, when the paper price can no longer be enforced because there's no metal to deliver, that's when you get a reset, a violent, disorderly reset. Let me explain the mechanism behind what's happening right now. In the futures market, there are two types of participants, hedgers and speculators. Hedgers are miners, industrial users, people who need price stability. Speculators are traders looking for profit. And then there are the commercials, the big banks, who act as market makers and often take the opposite side of speculative positions. For years, the commercials have been net short silver. They've been betting that the price will stay range-bound or decline. But when you short a commodity, especially in a futures market, you're not just betting on price direction. You're taking on delivery risk. Because at expiration, if the long side demands physical delivery, you have to provide it. And if you don't have it, you're forced to buy it in the open market at any price. That's what's happening now. The shorts are trapped. They can't cover without driving the price higher. And if they don't cover, they face delivery obligations they can't meet. It's a classic squeeze. But it's amplified by the fact that this isn't just financial speculation. There are real buyers who want real metal, manufacturers who need it, investors who don't trust the banking system, people who remember 2008, people who see what's happening to currencies around the world. And then there's the leverage. The derivatives market is built on leverage. For every ounce of physical silver, there are dozens, maybe hundreds of ounces in paper claims. Futures contracts, ETFs, unallocated accounts. It's a fractional reserve system. And like all fractional reserve systems, it works until everyone asks for their money at the same time. When that happens, the illusion shatters. And we're watching it shatter in real time. So what does this mean for the broader market? What does it mean for you? If silver continues this vertical ascent, if it reaches 100, 120, 150, the implications ripple far beyond the commodities market. First, it signals a loss of confidence in fiat currency. When hard assets explode in price, it's because people don't trust paper. And that has consequences for bonds, for the dollar, for the entire debt-based financial system. Second, it threatens the solvency of major financial institutions. The banks that are short silver, they're not small players. These are systemically important institutions. If they face massive losses, if their capital ratios are impaired, it could trigger a broader credit crisis. We've seen this before. In 2008, it was mortgage-backed securities. In 2026, it could be commodity derivatives. Third, it exposes the fragility of the COMEX and the broader derivatives market. If the exchange is forced to halt trading, or worse, impose cash settlements on contracts that demand physical delivery, it destroys trust. It tells the world that the market is rigged, that the rules only apply when the institutions are winning. And once that trust is gone, it doesn't come back. For investors, the calculus is simple but brutal. If you're long silver, you're riding a rocket. But rockets don't fly forever. They explode, or they crash. The institutions will fight back. They'll change the rules. They'll raise margins. They'll coordinate with regulators. They'll do whatever it takes to break this rally and destroy the longs. And history says they usually win. But if you're short, or if you're holding paper silver in an ETF or an unallocated account, you're facing existential risk. Because when the music stops, when the physical market diverges from the paper market, those paper claims might be worth nothing. You might get a cash settlement at a suppressed price, while the real metal trades at a massive premium. You might get nothing at all. What happens next? That depends on who blinks first. If the shorts capitulate, if they start covering en masse, silver could go to 150, 200, higher. The squeeze could become historic, legendary, the kind of event that gets taught in finance classes for decades. But that's the bullish scenario. And the establishment doesn't like bullish scenarios in markets they can't control. The bearish scenario is darker. The exchange changes the rules. Margin requirements go to 100%. Trading is halted. Cash settlements are imposed. The price is crushed overnight through regulatory intervention. Retail investors lose everything. Institutions are protected. And the narrative becomes, speculators got greedy. The market corrected. Stability has been restored. There's a third scenario, the one nobody's talking about. The physical market breaks away from the paper market entirely. Two prices emerge, a paper price on the COMEX, suppressed and controlled, and a physical price in the real world, where actual metal trades at a massive premium. That's what happened in gold briefly in 2020 during COVID. The futures price and the physical price diverged, and it's starting to happen again in silver. Dealers are selling coins and bars at 20 to 30% premiums over spot. That spread is a warning. It's telling you the paper market is a lie. But here's what I know. The fundamentals haven't changed. The supply deficit is real. The industrial demand is real. The monetary debasement is real. And the short interest, the leverage, the fragility of the system, all of it is real. So whether this rally continues or whether it gets crushed by regulatory intervention, the underlying forces remain. And they're not going away. So where does that leave you? If you're watching this, you're already ahead of 99% of investors. You're paying attention. You're asking questions. You're not blindly trusting the institutions that have been wrong about everything for the last 2 decades. But awareness isn't enough. You need a plan. If you're long silver, understand the risks. Understand that this market is manipulated, that the rules can change overnight, that paper promises might not be worth the paper they're printed on. Hold physical if you can. Store it securely, and don't trade on margin, because margin is how they destroy you. If you're on the sidelines, watching and waiting, know this. The time to act is before the crisis, not during it. Once the panic starts, once the real squeeze begins, or once the regulatory hammer falls, it's too late. Markets move faster than your ability to react. The question you have to ask yourself is simple. Do you trust the system? Do you believe that the institutions that created this mess, that shorted a market they couldn't control, that overleveraged themselves into oblivion, do you believe they have your best interests at heart? This isn't just a market correction. This isn't just a commodity rally. This is a warning, a signal, a crack in the foundation of a financial system built on debt, leverage, and trust that's running out. Silver at $94 is not the story. It's a symptom. The disease is far deeper. It's the everything bubble, the currency crisis, the end of a monetary era that has been running since 1971 when Nixon closed the gold window and turned the dollar into a pure fiat experiment. And experiments end, sometimes quietly, sometimes violently. Right now, silver is screaming that the end is closer than anyone wants to admit. The institutions are scrambling, the media is spinning, the regulators are preparing their interventions. But the market, the real market where supply meets demand, where physics and scarcity matter, that market is speaking a truth that cannot be silenced. The question isn't whether a crash is coming. The question is who sees it, who prepares, who survives. Because in every market dislocation and every crisis, there are winners and losers. The winners are the ones who saw the signals, who acted early, who didn't wait for permission from the financial media or the institutions that profit from your ignorance. This is your signal. This is your warning. What you do with it is up to you. If this analysis opened your eyes, if it gave you information the mainstream won't touch, hit that subscribe button, turn on notifications. Because this story is far from over. The squeeze is just beginning. The fallout is coming. And when the crash happens, when $94 looks like a distant memory, whether that's on the way up or on the way down, you'll want to know what comes next. Stay sharp, stay informed. And remember, in a world of lies, the truth is the most valuable asset you can hold. This isn't just a market, it's a warning. The question is, who's paying attention?